DeChara coming to you live from downtown Flushing, New York, once again for another amazing episode of How to Win at Business. And tonight I'm going to cover something that I've actually covered a lot over the last few weeks, but not individually. I want to cover the danger, again, of being a sole proprietor and trying to take an office in the home deduction, and why it's so crucial to know this information. If you're watching live, please give me a hashtag live. If you're watching the replay, give me a hashtag replay, because it makes me feel good that people are actually watching. And if you don't know me, I am a CPA. Over 35 years, I've worked with thousands of businesses. And why would you care? You don't care. Why would you care that I've worked with those amount of people for that amount of time? Well, if you're a solopreneur, if you're thinking about starting a business, you might want to think about something. The fact is that what I've learned is that when you start a business, you're at a major disadvantage against all the other people that have been in business for a while. That's number one. Number two, the machine. The machine is not just the IRS. The IRS government, the people in power, the machine has made it virtually impossible for one individual to start, build, and manage a business and actually get rich. When I was a kid, I was told that you can do anything. You could be president, and president didn't pay enough. I didn't know about all the stuff you can make after you're being a president, like writing and speaking and all of that stuff. I just thought that the salary was like, why would somebody want that? Why would somebody want that job when you can become rich? Today, the vast majority of business owners struggle just to survive. Forget about getting rich. And one of the reasons is that when anybody starts a business, they are automatically classified as a sole proprietor. And there are actually millions and millions of individuals that are sole proprietors that don't even realize it. They don't realize that when you get a 1099, when you're a freelancer, when you're an independent contractor, all of these different terms all lead to filing this form. And this is the most dangerous form that anybody can file when it comes to the IRS. And I'll tell you why. This is the form that tells the IRS, basically, this person's in business and they probably have no idea what they're doing, and they're probably going to make a mistake. And that's by design. But that's a whole nother story that we don't have time to get into here. But I want to show you a couple of things. So let me first give you a couple of examples of who sole proprietors are that don't realize it maybe. Uber drivers. Anybody getting a 1099? My cousin, who was working part-time as a counselor and was not considered an employee, she was given a 1099, and she is a sole proprietor. Good thing for her. Her mother worked at the IRS for a long time, and I'm a CPA. So, she didn't have to, go through, what a lot of people go through. And it could be as simple as, earning $20,000 on a side gig, and you take, that information to your accountant, and you just added $3,000 in self-employment taxes, just because you didn't know. And that's why I do this. So when you're a sole proprietor, you are basically commingling your business with your personal, because this is part of Form 1040. Form 1040 is your personal income tax form. Everybody knows that. Everybody has to file a personal income tax form. But if you have the honor of having a business, even if you don't know it, this is where you're going to report the money. And this is where all the red flags are hidden. So one of them is this on line I. Did you make any payments that would require you to? Now, what they're asking is, did you hire any other independent contractors? Because we want to know about it. And if you did, now this is, okay, so if you did make payments that would require you, now they want to know, did you do it? So think about how silly this question is. If I say, yes, I was required, and then I check no, well, I was required, but I didn't. I just didn't have the time. That's a red flag. Now, why would they even put that question there? Because that's why. So in a nutshell, if there was ever an audit, if they wanted to prove intent that you would, intentionally, well, that's probably some kind of crime, or it shows that there was an intent to not, tell them what they want to know. So your income would go up here. A lot of people don't even know what expenses they can take. But this is what I want to show you here, because the whole thing about tonight's training is, if you are a sole proprietor and you do work from home, you are entitled to take that portion that's business use. And this is where they have it. That they actually have a special line for sole proprietors, so that you can specifically tell them, hey, this is how much I want to deduct. I only made $10,000, but I got $40,000 worth of home expenses I want to write off. Well, that's a red flag. Okay, they're asking for information, and there's a reason why they want it. They want to know who's taking the office and the home deduction. Now, so that's the amount, but now this amount comes from this form 8829, where they want all kinds of information on the business use of your house, direct, indirect, blah, blah, blah. And then they're going to tell you where this goes. It's more. So that's if you're a sole proprietor. They also have all kinds of information on home office deductions. It's endless. So now, how do you not have to file this and still get the benefit of the home office deduction? Because let's face it now, folks, most people are working from home. Even if you had a regular job that you had to go to, you might not be going there. But if you have a business, the chances are pretty good that you can legally deduct a portion of your home. And now my stealth tax strategy is, I'm going to show you how you can legally write off that expense, and there are no red flags, and it has to do with becoming a corporation. You do not want to do business as a sole proprietor. You want to do business as a corporate entity. Now, you can be an LLC and elect to be taxed as a corporation, but LLCs are automatically, a single member LLC is automatically classified as a sole proprietor. So now, if you're a corporation, first of all, if you're a C-corp, it's totally stealth, because the C-corp does not even flow through to your personal return. But if you're an S-corp, the net profit of the S-corp will go here or here if it's a loss. There is no information about your home. So now, how do you get that. Let's see. 1120S. So I want to show you when you're at an S-corp, this is what you put in here. There is no office in the home form. Okay. When you pay your expenses, let's say you're going to get reimbursed for your utilities, it will go under other deductions. If part of your real estate taxes are in there, it will go under taxes. All of the expenses are going to be embedded, included in all of the other business expenses. So that, and where that goes is over here. They're on the IRS. When you're an S-corp, they have no idea that you're taking an office in the home. So how do you do it legally? Well, the thing is that there are rules for getting reimbursed for out-of-pocket expenses. And it was really designed for when employees went out and got reimbursed for job-related expenses. And they would give their employer, their boss, an expense report. Well, the same thing is true when you have a corporation and you as a shareholder, employee, owner, want to get reimbursed from the corporation for business-related expenses that you've laid out of your pocket. So now when your home becomes business use, you are laying out the money out of your personal checking account. You're paying the mortgage, you're paying the rent, you're paying the utilities. So all you need is a legal document between you and the corporation that says we are going to, we agree to reimburse you for the business part of your home. And now this is the actual, the books and records part of it, because you have to actually produce a document that's going to show how you came up with the amount. So it's really, it becomes very, very simple. You could do this on a monthly basis, on a quarterly basis. I would, recommend that that's how you do it, at least on a quarterly basis. You come up with your business use. And over here is, these are, and you can make up your own spreadsheet. This was just to show you as an example. I mean, you could do it on a Word document. It really doesn't matter as long as you have the documentation to back up the deductions. So last thing on this is there are different categories. There are direct expenses and indirect. So a direct expense, so right now I'm sitting in my home office and I painted, I spackled, I did some repairs. Those are all 100% deductible because it's part of the room. Then there's indirect, rent, regular plumbing repairs, anything to keep up the facility. And it's a simple mathematical equation. We come up with the amount, and now this is based on these numbers. My corporation would produce a check, cut a check for $6,049.59 to reimburse me for these categories. And now when your books are done, that check made out to Joe DeChara is going to these categories. You print it out, you put it into your folder electronically, you cut the check, you're good to go. And it's 1,000,000% legal. They cannot disprove it as long as you have the documentation. And that's my #1 stealth tax strategy for tonight. I'll be back for more. And I'm having fun. God bless. I will see you back again tomorrow. Thank you.